The stock of the day is EBOS Group. Now, why? That is because it has made an acquisition. It's buying Life Healthcare's Australian and New Zealand units, and 51% of Life Healthcare's Asian unit, Transmedic, from private equity for almost $1.2 billion. It will be funded by a $742 million cap raise. So Life Healthcare is a medtech business which supplies device implants and other equipment for spinal and orthopedic surgery. So EBOS's CEO John Cullity saying it's an important step in the medical devices strategy, providing greater exposure to the high growth sector as well as a measured entry into Southeast Asia. Claude, I'll start with you. EBOS Group, do you think that this is a company that's a bit underrated?
Yeah, definitely. So this, just a disclosure, I've owned this for a while. I think, even when the call started back in the midst of the pandemic, that's when I first talked about it on this show, because basically EBOS Group was a company that is so big and well run and resilient in healthcare that I was willing to buy it even when I was most freaked out about the pandemic, because, they have a huge network of, like, say, the Terry White chemists that you'd be aware of in Australia. They have a huge pharmaceutical distribution, healthcare distribution network. So, and they actually do distribution for Chemist Warehouse as well, although, of course, there's a bit of risk in that since Chemist Warehouse is such a big player. The point is that these guys are huge in healthcare distribution, and obviously that's going to be pretty solid no matter what happens. And, sure enough, in the last year, it has been a strong run, as we're seeing on the chart there. Now, to answer your question briefly, yeah, I do think it's underrated. It's a big, solid, in my view, has blue chip kind of qualities, but yet people don't talk about it that much.
Okay, so that's quite the chart that we're seeing over the 5 years. Ooh, it's in trading halt today, obviously, but would you be a buyer of EBOS now?
Yeah, so of course, now it is starting to get a little bit of the recognition it deserves, and its dividend yield, which is like the main reason that I do own the shares, is down to, I think, about 2.5%. So that's probably a little bit lower than I'd like to get it. Maybe looking for around 3% dividend yield for a sort of solidly slow grower like this one. However, it's a really pertinent question, because as a shareholder, I'm going to have the right to subscribe for shares at, like, I think around 32.80 or something like that, which is a little bit below the current price. I'm talking about in AUD right now. So, because it's also listed on the NZ Stock Exchange. But, so I don't know if I will actually subscribe for those shares yet, to be honest. I probably won't. But this is definitely one that I'm holding on to it, and I may buy some more discounted shares, especially if the share price stays where it is. But generally, I'm not that enthusiastic a buyer, but it is the kind of stock that I think of as quite defensive, and therefore, I don't mind buying it if there's some massive sell-off, because I'm pretty sure it'll survive.
Carl, maybe that's where we can pick it up with you for EBOS Group. If you look at price and momentum, would you look to pick this company up at a cheaper price?
Yeah, I think Claude should take up his entitlement there, and if you can get them at a bit of a discount, why not? I mean, we saw on a chart earlier on, it just is great trends, bottom left, top right, and they're my favourite kind of charts. And, my philosophy is, the reason why it's doing so well is because the market is understanding why you want to own this stock. So lots of people are demanding the stock. Price wants to go up, and very few people are supplying the stock, and that's helping price go up. And you think about the demanders, they're obviously looking at the bigger picture, so they want to own it. You think about the suppliers. They don't want to sell it. Why don't they want to sell it? Because they think there's more in it. So bottom left, top right, I think is a great start. I zoomed out when Claude said he was talking about it during the pandemic. I zoomed out because I thought, even a lot of healthcare stocks had this huge drop in the pandemic, and of course a huge rally. This one barely flinched. It was actually so strong in the pandemic. It sort of speaks to the underlying defensive nature of this business and just how solid it is and how diverse it is. And I've only seen headline stuff for the acquisition today, Nadine, but it looked pretty solid. I mean, I think they're getting it at a pretty reasonable price. It was 11 times EV to EBITDA compared to the group's sort of 17 times. So I think that's pretty good for them. It's going to be EBITDA accretive. It's a solid business, as Claude says, sort of high single-digit growth rate. So it's not one for those crazy growth investors. It's more for your self-managed super fund, core portfolio holding. To answer your question, would I buy it to take up the discount, your allocation? If you hold it, yes, I would buy it there. If I didn't have it, would I add it to a long-term self-managed super fund portfolio? Yes, I would.
Thank you. So that is the stock of the day, EBOS Group, EBO.